What if I told you one of the most controversial crypto projects ever has over tens of millions of users, most of whom didn't spend a single dollar to get in? No GPUs, no mining farms, just a phone. That's Pi Network and its token, PI, loved by its community, doubted by critics, and now finally stepping into the real crypto arena. At its core, Pi Network is a blockchain project designed to make crypto accessible to everyday people. Instead of requiring expensive hardware or technical knowledge, Pi lets users mine coins using a mobile app. You open the app once a day, tap a button, and you earn Pi. The big idea? Crypto for the masses. Pi was founded by Stanford PhDs, and from day one, the focus wasn't traders, it was user adoption. Think of Pi like Bitcoin's distribution dream mixed with a social network growth model wrapped in a mobile-first experience. Let's break this down in plain English. Pi doesn't use proof of work. Your phone isn't burning energy or solving equations. Instead, mining is more like participation rewards. You earn Pi by logging in daily, being an active user, growing the network responsibly. No battery drain, no hardware wars. Pi uses a trust-based consensus model inspired by Stellar. Users form small trust circles, which collectively help secure the network. Instead of brute force, social trust plus cryptography. To move Pi to the mainnet and actually use it, users must complete KYC. This filters bots and duplicate accounts, turning millions of signups into real humans. This is crucial. Pi is betting on clean distribution, not anonymous farming. Pi isn't just a token. There's Pi browser, Pi apps and marketplaces, payments between users, merchants already accepting Pi in some regions. The goal is utility first, speculation second. Now let's talk numbers, because vibes don't move markets alone. Max supply, 100 billion PI. Majority allocation, community mining rewards. Other allocations, team, ecosystem development, liquidity, foundation. Pi uses a declining issuance model. The more the network grows, the slower new Pi is minted. Key things to understand. Most Pi was earned, not bought. Circulating supply increases as users migrate to mainnet. Unlock behavior depends on user activity and KYC completion. Large supply doesn't automatically mean bad. Distribution and demand matter more than raw numbers. If Pi sees real usage, supply pressure can be absorbed. If not, dilution becomes a risk. Here's why Pi keeps coming back into crypto conversations. The narrative, the most widely distributed crypto in the world. That's the pitch. Instead of whales and VCs controlling supply, Pi aims for massive retail ownership, grassroots adoption, real-world payments. In a cycle where retail returns, that narrative hits hard. Potential catalysts include expansion of the open mainnet ecosystem, more real-world merchants accepting Pi, improved liquidity and accessibility, major exchange listings, growth of Pi native apps. Macro-wise, if mobile adoption, emerging markets, retail crypto usage continue to grow, Pi is positioned directly in that lane. Let's be honest, Pi is polarizing. Massive global user base, extremely low barrier to entry, strong community loyalty, mobile-first and energy efficient, clear focus on utility, not just price. Long development timeline frustrated many users. Unclear short-term liquidity dynamics, massive supply requires real demand, skepticism from parts of crypto Twitter, adoption must go beyond the community itself. This is not a guaranteed moonshot, it's a high-uncertainty adoption bet. PI may be interesting for long-term adoption believers, emerging market crypto users, utility-focused holders, narrative traders in retail cycles.